Hi, I'm Dave,
And I'm Paul.
and we're going to challenge you to transform your financial future through the principles of the most profitable business in the world, banking.
We believe everyone should be involved in two businesses, the business that you're in and the banking business. Everyday people can replicate what bankers have been doing for centuries to leverage capital and build wealth through private lending.
Join us as we uncover the truths about money, expose lies and myths, and flip conventional financial advice on its head. Here we go. Hey everybody, hope you enjoyed last week's part 1 of policy loans versus bank loans. Paul and I are back for week 2, so we'll just pick up this where we left off. But before we get started, we're kind of recording this on the same day, so we don't have any new small talk to discuss. I'm sure everybody's really upset we don't have any small talk.
What's the weather? Oh my goodness.
Yeah, it's still the same as it was last week.
Still the same
because
as it
it's
was
the exact
3
same
minutes
day.
ago.
Yeah. Yeah. So that's why we're wearing the exact same clothes too. Anyway, so
I still love bellows.
Yeah, Paul. Yeah, there you go. So if you don't know what he's talking about, go back and listen to episode 1 last week. But yeah, I hope you enjoy this second episode. I think we make it pretty clear, make the distinction pretty clear that the difference between bank loans and policy loans are pretty much incomparable. It's really, you can't, they're apples to oranges when you really get down to it.
One is great. One is generally just terrible.
Generally just terrible. Yep, there you go. Couldn't have said it better myself.
Yeah.
So, all right, everybody, enjoy part 2, and we'll see you next week. That kind of gets us into, I'm going to skip over the next one, but we'll come back to it, that, the type of loan and how loans are structured. With a commercial bank, they're typically amortized. Unless you've got a HELOC or something. An amortized loan means the bank is factoring in principal and interest on every loan repayment. And oftentimes that interest is going to be much higher at the beginning of that loan than it is at the end. So they're getting their cut early. They want their profit right away.
Yep. They love interest.
Yeah, they love interest. It may say, 3% interest, but when you look at the amortization table, they get most of that up front as opposed to later on in life,
Right.
of the loan.
I think about the mailers that I get or commercials you might see if you're watching TV or YouTube and you see, an advertisement for, hey, do a cash out refi. And of course, people are like, I'm at 3% right now or 2.75. Why would I go to 7?
Right.
Well, you might because you need the cash.
Oh.
That's in the house, right?
Yeah.
And you don't have a choice because all your money's locked up in a qualified plan or all your money's locked up somewhere else that you can't get to because government controls it. So now you're...
Yeah.
Anyway,
desperate times call for desperate measures and make you do stuff that doesn't make sense on paper.
Correct.
Yeah. Yep. But when it comes to repaying your whole life policy loan, depending on what company, every company is a little bit different. Some of them kind of take out the interest at the beginning and then they add it back to your, unused interest or whatever, add back to your cash value as you pay loans back.
As you pay loans back, sure.
Yeah. But, with one of our favorite companies, it goes to the principal. 100%
Yes.
of your loan repayment. If I pay back $1,000 today, $1,000 goes towards the principal reduction of that loan.
Right.
Not towards the interest. That interest is calculated daily, accrues annually. So at the end of every policy year, you look back and they say, hey, here's how, based on your daily balance, here's how much interest you've accrued in dollars. And it's likely, if you're making loan repayments, it's going to be far less than whatever that original calculation of 5% or 8% was.
Sure. No question.
Yeah. So, that's hugely advantageous to go towards the principal. 100% of your loan repayment, eating up the principal, eliminating that, and then whatever's left over is the interest.
Right. It's more interest-only line of credit-ish than it is loan, right? Like amortized loan. That's how I would look at it.
Right, because it's like a line of credit, right? Where you're only paying interest on the outstanding balance.
Right.
Yeah.
Exactly right.
Very similar. So what about repayment terms? So with a bank, who makes the repayment terms with a bank? Even with a HELOC, a line of credit, oftentimes there's going to be
a minimum payment.
There's always a minimum payment, right?
There is. It's the interest. It's the accrued
interest. I think some even require
there may be
principal
some
and
fees
interest.
or Yeah.
Yeah.
I'm trying to think what mine is. I don't really. Mine's an interest-only HELOC, but I'm trying to figure out how it's. Again, I don't use it much, so I don't really pay attention. I just know when I have a balance, I pay it off.
Right.
But you make a payment on a regular type amortized loan, that the money is now gone.
It's gone. Yeah. Once you repay those dollars, do you have access to them again?
No, I mean, in the case of a car, you'd have to sell the vehicle, depreciation, whatever, and you get some of it back, arguably. But same thing with a house. Like you're creating equity, you're paying interest, of course, but to get the money out of it, you'll still need to get rid of the asset or go with your hat in your hand. Like, can I get a HELOC? No, sorry, you can't.
Yeah. Just like the one client we mentioned last week, whose bank said, you should apply for a HELOC. He applied, and then they said, sorry, we're not going to approve that.
Right.
Like,
and, for a policy loan repayment, I kind of look at this. I've got the money inside my policy chugging along, and I'm borrowing against it, right? The cash value. And then when I make a policy loan repayment, those are dollars that are just going back into my system that I can access, generally with the company that we use about 2 weeks later. Mm-hmm. I could take that money right back out if I needed to. I showed somebody that the other day too on my own portal. So it's, you're recycling dollars and you're not stealing the peas. You're being an honest banker with yourself. So it's kind of like putting money, I don't know if this is a good analogy or not, but it's kind of like putting money back into your savings account that you took out, except, your money is not interrupted. It's earning potential.
Yeah, your money was earning the entire time.
Right.
Right. Yep. Nice. So what do banks don't take risk. Banks take collateral. Right? So what kind of collateral do they want you to put up? For a HELOC.
All of it.
All of it. I mean, for a HELOC, that's
all
pretty
of the
obvious.
collateral.
Yeah.
Right. Well, let's face it. And when you get a loan from a bank, that is fully collateralized. So on a vehicle, let's say, most people end up you're upside down the minute you drive off the lot. Right. You're upside down. The car loses 20% of its value right out the gate. And people go, oh, actually, in 2020, I was able to. Well, these were weird times, right? Supply and demand and whatever. Yeah. Amazing what happens when a government shuts down the economy, right? It's almost like it creates imbalance in normal economic conditions, so which otherwise wouldn't have existed, right? Absent government intrusion, everything would be fine. Let's face it. Anyway,
so they take collateral. Yeah. They're going to want something.
All of it,
right? And what is the collateral with your life insurance policy? The collateral is your death benefit.
Correct.
Right? That is the asset that is being collateralized to guarantee that loan that the company is making to you. Because what are you guaranteed to do at some point?
You're gonna die.
You're gonna die. You're gonna graduate. You're gonna kick the bucket. You're gonna be gone. You're gonna expire.
None of us have a lease on life, do we?
Right. That's guaranteed, and your death benefit is guaranteed to pay out because it's a permanent life insurance. So that is the collateral, which means any unpaid balance that you owe is simply removed from your death benefit, and they get to recapture that unpaid balance before they send the rest to your family, to your heirs.
Right, and it makes sense when you think about it, Dave, because the cash value is simply the equity in the policy. It's what the death benefit is worth today. Yeah. So by taking a policy loan, right, you are accessing death benefit. You're just accessing it now. So it makes total sense.
Because you own some of it now. Yeah.
Right. It's no different if you had to, for those of you that are our clients and you've got, the accelerated death benefit plus rider, accelerated death benefit rider, just the regular one, which you can access for different conditions or terminal illness, whatever it is. Really what you're doing, it's the same thing. You're just accessing the death benefit, some of it, now. So you can make your medical payments, whatever. And it accrues, it's a policy loan, right?
Yeah.
That's literally what it is. It's a policy loan.
Yep. Hey, I'm going to take that future value, value that's in the future, many decades from now, and I'm going to use it now. For something I need, because do you have a bigger need for a death benefit or for financing the things of life?
Well, according to Nelson, finance.
Yeah, financing the things of
But
life is the biggest need you have right now.
right,
You know?
right, because odds are you're not gonna, you know, statistically speaking, you'll be fine through age 65,
Yeah.
likely through age 75. So
There
anyway,
you go.
but by creating this entity called, you know, becoming your own banker, right? By practicing IBC, you're going to end up with more death benefit than you otherwise ever would have purchased anyway.
Oh yeah. Yep. And your death benefit is an asset. What do banks take as collateral? They take assets as collateral. So
That's
guess
right.
what? If you really, really wanted that 2% bank loan, instead of borrowing against your policy at 5%, the bank will take your policy as collateral and give you a 2% loan probably. A lot of people did it during those artificially low interest rate times. So
Yes.
it's your cash
Especially
value
direct
is
recognition, folks.
yeah, right.
Sorry, I had
Your,
to say it.
your cash value is as good as cash.
Yeah.
So that is an asset that can be collateralized. I'm not doing it. Paul's not doing it.
I don't
but
want to do it.
It can be done.
I'll never do it.
But the banker gets to make the rules. Can do whatever he wants.
That's right.
If that's something you want to do. So, no, we talked a little bit about, what happens if you don't repay your loan in terms of a life insurance company. What happens, which is basically nothing until you die. Then they take back whatever you owed. Now, beware. One caveat to that is, a modified endowment contract. You can get yourself into trouble if you go years and years and years taking max loans and never repaying anything, right? Which would completely defeat the purpose of becoming your own banker.
Yeah. Stealing the peas,
stealing
policy
the peas.
collapses, cannibalizes itself, and now you've got a taxable event potentially. So
Right. Only somebody who didn't understand what they got into in the first place would be doing that.
right.
So, but what's the penalty for not repaying your loan or missing a payment on a loan with a bank?
Well, there's going to be there's if you read your little thing that you signed, there's some fees in there. I'm sure there's late fees, there's interest. It's kind of like when you're, for the IRS, same thing, right? Like there's a state under the union right now that owes me just over $10,000. Actually, it's just under 11,000.
Yeah,
because I
and you're not
overpaid in
getting any
taxes.
additional interest on that one.
And I'm not earning anything on it. I talked to them earlier this week, and I said, "Hey, I've been calling now for 4 months."
Wow.
Then my next call is to the Secretary of State,
Yeah.
who's a Republican, by the way. So
Yeah. So maybe you'll get some help.
anyway, yeah,
But so the bank can, assign penalties, fees.
yes,
They can
And they
seize
do.
your assets, right? Whatever you put up as collateral, they can seize that. They have the right to do that if they choose to.
yep,
They can crush your credit score. If you miss a payment, you're going to have that ding on your credit score. And maybe you can call in and be like, hey, can you give me a one-time forgiveness and get this off my credit report?
right,
Which I've done before because of accidentally missing a payment.
yep,
You could end up in bankruptcy. And it will, a late payment or a non-repayment of a bank is certainly going to heavily affect your future ability to get another loan.
correct,
So
right,
a lot of downsides to missing a payment. Let's say you have a bad month. You miss a payment on your life insurance loan repayment. Doesn't matter. Who cares?
doesn't matter.
Yeah, you just pick up the next month or whenever you're able to.
Yep,
So
that's what it's there for.
Yeah.
It's all payments, premium and loan repayment are all going into an asset that you own and control, and that's how you should view it.
Yep. There you go. Now, what about tax implications? Basically, I mean, on either one, there's basically no tax implications because they're both loans.
They're both
And the
loans.
IRS does not classify loans as income. Therefore, they're not taxable.
Finally, a win for the banks.
Finally, something the banks do just as well as life insurance companies. If it was up to them, who knows? But
Right.
it's not. Now, let's caveat that provided your policy is not a modified endowment contract. Once it's a MEC, any loans you take are going to be taxable income. So don't, which is why we design these policies to guarantee they will not MEC unless you want them to, which you won't.
Yeah, which you don't.
Right. You don't. So when you absolutely need money, when you need access to capital, does the
Like,
bank
I really
want,
need it.
does the bank want to lend you money when you really need it?
No, we like to joke, and because it's true, really. I mean, the banks don't loan money to people who don't need it.
Right.
But if you need it, good luck getting it.
Yeah.
When you really need it,
When you really
nobody
need it.
needs a new car generally. Like sometimes
Yeah.
they do,
So
but you know what I mean.
They like
So,
they want to loan money to people who don't need it,
right.
because that means you have the ability to repay it.
Go back to the Warren Buffett, Jeff Bezos episode.
Yeah. There you go. Now, regardless of what's going on, let's say you lose your job, you lose all sources of income, you have medical bills, all that other stuff that would, just the banks would turn you away in an instant.
Yes,
What about policy loans? Can you still get those?
of course.
Yeah, absolutely.
No different.
Yep. Go back to your contract. You're first in line. They don't ask why. They don't care. Here's your loan. So with all this said, there's so many pros to policy loans and so many cons to bank loans. They're almost not even comparable, truly. But if you want to compare, we just did. So what it comes down to, really for us, is control. How much control do you have over that loan? With the banks,
Well,
I think it's pretty obvious you have very, very little control whatsoever.
Right. You have no control. And I think that's why people, oh, I've got an extra $2,000 a month of cash. I'm going to throw it against my student loans or this loan or that loan. Because they want to be out from the bank, under the bank's thumb, right?
Yeah.
And I get that.
Yeah, I know. It's not a fun feeling.
It's not a fun feeling, is it?
Yeah.
So, but when you have policy loans out, you don't feel like, the life insurance company's crushing me. No, it's not happening. You're in complete control of that loan, the repayment schedule on it. You're the bank owner, you're the loan officer, and you're the borrower, all wrapped into one thing. And it's a powerful position to be in.
Yeah.
I will say this, folks, and I had this conversation yesterday with a prospective client that, they've got some debt, and I was like, well, let's talk about that. How much money can you throw at this debt? And, someone always has all this extra money. I got to throw extra money on the credit card, and it ends up, when they add up all the extra money they're paying on things, it's sometimes thousands of dollars per month. And what they're actually doing, right, is they're prioritizing somebody else's bank's capital.
Yeah, you're right.
Right? Instead, their mindset should be, let me prioritize my capital. Where can I accumulate capital? And at the end of the process of accumulating X amount of capital, I can be debt-free and still have all my money, all my cash that I was throwing at this thing.
Yeah.
And of course, this is the answer. I said, we're going to structure a policy, or actually two policies, one wife, one husband, where we're going to take all of our extra cash, what should be our capitalization money, our savings, and we're going to put it in a policy. And then we're going to we're going to insert those two policies in between, you and your debt. There's going to be two life insurance contracts. And when you're going to do what Dave Ramsey tells people to do, the debt snowball, which is just fine, right? It's a good way to do it. And you're going to do the same thing, except at the end, you'll have the same result, except you'll have this asset, death benefit. No tax on all the money you paid in premium ever again. All these other things that we talk about in this podcast. So not that I want a bunch of people reaching out that have, $50,000 of credit card debt. It took hard work to get into that place, and
Yeah, for sure.
call us when you're out of it. But it can be done.
And
But you need
that
discipline.
Yeah. Episode 11, using IBC to eliminate debt. So go back, listen to that. That was one of the first ones, 2 years ago.
It's our most popular, most viewed YouTube video, actually.
Really?
Well, it just goes to show you that debt elimination is such an important topic for most Americans, especially, it always is, but especially now. And, but most people are going to do it the wrong way.
Yep. So there are different ways to attack it.
Yep.
So nice, man. Well, hey, we went a little bit long, but I think that was we covered a lot of ground. So if you're still not convinced on why life insurance policy loans are better than bank loans, listen to this again, read the book, read Nelson's book, Becoming Your Own Banker, and concentrate. I don't know, challenge your traditional thinking on all that, and look beyond just the interest rate. So, really
about
comes
banking.
down. It's about banking, and banking is about control. And with that said, until next time, control your capital.
Or somebody else will.
Hey, thanks for listening, everybody. If you'd like to have a conversation with us to see how you can become your own banker, or if you have any questions or topics you'd like us to tackle on a future episode, please send us an email to davidandpaul@theibcguys.com.
And subscribe and leave us a review if you're on Apple. Follow and leave us a 5-star review if you're on Spotify. And please share this with your friends. We'll see you next week.